Scott Bessent just screwed Kevin Warsh, or at least made his job really, really difficult. Hi, my name is Drew Urasek. I'm the owner and founder of The Complete Investor at thecompleteinvestor.net. And I'm really doing a follow-up video from the webinar we did last week, Thursday night. I am a board member of Wealth IQ Group and its subsidiary, Gold IQ. And I had my partner say, "What the heck just happened?" And a lot of clients, "What the heck just happened on Friday?" Right? Gold jumping, 3%. Thursday jumping 3%, and then Friday jumping 2%, and then jumping again yesterday. And all at the same time that all this stuff is unraveling at the Treasury and the Federal Reserve. And so it's very important to understand. And again, I have to laugh because it's almost comical. And you just watch the smart money, watch the big money in the markets and what's happening. And it's all reflected in gold. So let's just recap on how messed up this is. Now, I'm going to keep it very high level. I'm going to be abbreviating a lot of content and a lot of mechanisms that our federal government does to play this shell game with our debt. But just remember, going back just a few weeks ago, the Federal Reserve, actually the U.S. Treasury Department, stepped in to save the Japanese yen. Now, what does saving the Japanese yen mean? The Japanese yen was tanking. And our government thought that our number one buyer of 30-year bonds was about to dump their bonds on the market. And to stop them from doing that, they said, "We'll buy your yen to prop it up." Okay. By the way, it didn't work. Lasted about a day. Yen started tanking again. So they realized, and again, this is my interpretation. You can do your own research. And this is me reading about this stuff almost every day because it's almost laughable. I have a business background, took business classes in college, even graduate school level business classes. And so I am just absolutely dumbfounded at this almost lying and charades that are going on. And Bessent says on Thursday that we're going to be buying the long-term treasuries, right? The long-term bonds to control that market, provide liquidity. You know what that means? Nobody wants our 30-year treasuries. Nobody wants that debt that long. They know how bad we are financially as a country, and nobody wants our debt. Japan was about to dump their debt on the market. We had to come in and swoop in to save it and stop them from doing it. And all of a sudden, a couple, 3 weeks later, we're magically buying our 30-year treasuries. Now, this is why, and I have to do this video, why it's so messed up and why it's going to make Kevin Warsh's job that much harder. And I personally believe he just screwed Kevin Warsh, because the only way, essentially, the only way Kevin Warsh can control inflation is by raising interest rates. And back earlier this year, there was a 90% chance, the market priced in a 90% chance that the Federal Reserve was going to raise interest rates 3 times by the end of the year. And by the way, I've done video after video after video on this. I have blogs on this. You can go to my website, see any of the video archives, thecompleteinvestor.net, go to the webinar section or the blog section and see all of this content. And or go to YouTube and look up Gold IQ Group. And the video we did on Thursday night last week, we talked about $4,000 gold is gone. Okay, it's our belief that $4,000 gold is gone because, again, all of these things have happened just since July 2nd. Okay, you can watch gold since July 2nd and see this trajectory it's on. Okay, now Bessent and the Treasury Department said we're going to buy long-term rates. And again, it's because we cannot, no one wants our debt. Okay, and the only mechanism that our Federal Reserve has to control inflation is by raising interest rates. Well, their policy, the Federal Reserve policy on interest rates increases, have decreased to down to as low as 30% because of all of the things that have happened since July 2nd. So they're really handcuffed. They can't control inflation, not with interest rates at least, okay? Short-term interest rates. And this makes it worse. Why? Why does Scott Bessent's initiative to buy long-term debt, okay, take it off the market, reduce that long-term rate because of it, okay, or essentially that's the effect it will have because we're going to be taking bonds off the market by the Treasury buying them off the market, okay? I say it's because nobody will buy them. But what that essentially does is forces them to move that money to short-term debt. Now, everyone in the market was saying this is the worst idea ever because he's basically going to take long-term money and change it into short-term money, okay? But he came on and said, oh, and watch gold when he announced this, 3% increase. So he announced that he was doing this, and on Thursday, gold jumped 3%. And so the market not only knew that was a big shell game, a big distraction from what's really happening, we're going broke. Okay. Friday, all the interest rates went back to normal. They came down a little bit and then went back to normal. And as a matter of fact, I think for a little while, they actually went higher. So interest rates actually went up. So they know it wouldn't work. So Monday, he had to come on air, Scott Bessent, and say, don't worry, we got plenty of money to buy more debt if we have to. We have $940 billion in our Treasury General Account. By the way, they don't have $940 billion. That money, they actually have to legally keep a certain amount in there to make sure we can run our government. They might have a couple $100 billion, but they said we have $940 billion we can buy debt with. Okay, let's say they do. How do they replenish that account? So let's say they draw it down 200 billion, 300 billion. And by the way, Thursday night I talked about that increase was not only not enough, the market knew it wasn't enough, and that's why he had to come on air and say, we have $940 billion to spend. This is the problem. Scott Bessent, if he has to replenish those coffers, which he will have to, because we need a certain amount in there legally. There's a law that says you have to keep this Treasury account at a certain level to pay our bills for at least a few months or whatever it is. It can't be a year because a year we spend $7 trillion a year. But I think it's 1 quarter's worth of money, which is like $500 million or $500 billion, $500 billion we have to keep in the account. So we really only have a couple $100 billion of access. But once we draw that down, where do you think he's going to get that money? He's got to create short-term treasuries. And this is where he just screwed Kevin Warsh. Because Kevin Warsh's policy, an interest rate policy, right? When he raises interest rate to control inflation, it affects short-term debt. So Scott Bessent is spending money that Kevin Warsh has to raise interest rates on if he wants to control our debt and increasing our debt load and debt servicing costs exponentially, right? So it's like giving your kid a credit card and saying, hey, listen, don't spend this unless you need to, and they just spend as much as they want. You have to pay the bill, right? So Kevin Warsh essentially will not be able to raise rates because it will immediately increase the cost of doing business as a country, right? Our debt service will go up through the roof because Scott Bessent is buying billions and billions and billions and possibly because he said $940 billion available to him, $1 trillion of our debt. That's insane. So Kevin Warsh now has to go in front of the board, right? The board of directors or board of the Federal Reserve Board and say, hey guys, Scott Bessent is spending tons of money and he's going to have to reissue short-term debt to pay for it all. And if we raise rates, it's going to basically increase the cost of all of that new debt he just created. That's the problem. And again, I hope you see that because this debt, I'm going to go to presentation that we did on Thursday night, just hit $40 trillion. We doubled our debt as a country in less than 10 years. We went from under 20 trillion to over 40 trillion in under 10 years. The expectation, don't believe me, go out there and do your own research. There are analysts saying that we could probably double our debt in the next 4 years. Okay, now look at this chart. This is since the beginning of us coming off of our gold standard, meaning that our dollar is backed by gold. We officially completely came off the gold standard in 1971. That's when we completely decoupled from gold and the dollar. Gold was $35 an ounce, and as of yesterday, it almost hit 4,800. That's over a 13,000% increase. I'm saying, remember that. You can see the math down here. Our national debt went from 400 billion to 40 trillion in that same time, a 10,000% increase. Gold always stays ahead of our debt. So if our debt more than doubles in the next 4 years and gold stays ahead of our debt, shouldn't gold more than double? So in my opinion, you want to protect yourself. Get away from anything tied to our debt, right? Physical precious metals not tied to our debt. And gold is not only not tied to our debt, it's not even taxed the same. It's not taxed the same as stocks, bonds, mutual funds, annuities, or even cryptocurrency, which I'm sure in retirement you'd probably rather spend less money than more money on taxes. And there are coins you can buy that are deemed non-reportable by the IRS. Yep, you heard me right. You can actually buy coins that are deemed non-reportable by the IRS. If you want to meet with me, I'm going to put my calendar in the info section of this video. Again, I really want you to see this. Scott Bessent coming in and saying, hey, listen, we're just going to buy these long-term treasuries, take them off the market, provide liquidity, because no one wants to buy our 30-year treasuries, essentially, right? And, oh, by the way, we have $940 billion to do that. Oh, but we legally have to repay that money. If we do, we're not going to reissue 30-year bonds. We're going to reissue shorter-term treasuries, right? 10 years or lower. Well, that's effectively what Kevin Warsh, our Federal Reserve Chairman, has, control over with policy, right? Interest rate policy affects short-term treasuries. So he can't go and start raising interest rates on all this new debt that the Treasury Department, he can, but he's going to absolutely annihilate the entire market. So what's essentially going to happen, and this is my personal opinion, is the Treasury is going to be spending money, possibly trillions of dollars buying our debt. The Federal Reserve is probably going to be buying our debt as well, right? QE, because no one else will buy our debt. And they can't raise interest rates, which means it's only going to accelerate the debt increases. And that's why a lot of analysts are saying we'll probably double our debt in half the time. Right? We doubled our debt in half the time, 10 years, right? From the prior 20 years, we just doubled our debt from 19 trillion to 40 trillion in less than 10 years. Prior to that, it doubled in 20 years. The next doubling is probably going to happen again in the next 4 years. So if our debt doubles and gold goes up with our debt, don't you think gold might double? Again, meet with me. You can click on the chat, watch any of our videos online. You can search them on YouTube, Gold IQ Group, especially the $4,000 gold one, $4,000 gold. Great information. Talks about all the things that led up to this debacle, if you will. And again, I can't see a way out of this other than accelerated debt, accelerated spending, and really hyperinflation, even more so than we've already experienced. Be safe out there.